All right, everybody. Hello. Welcome again. For those of you who were just with me and we had the audio problems, I apologize, but hopefully we've got it worked out. And if you could let me know in the comments below how this sounds, I want to make sure we're good before we get into the content. Just give me a thumbs up. Let me know it sounds okay, or let me know it sounds awful. Either way, just want to hear from you. And then I'm going to get started with our topic today, the simple math of early retirement using real estate. Awesome. Somebody says, sounds good. BiggerPockets does. And I'm looking on YouTube. We got Bernie here. Hello, Bernie. Kingston Productions is here. Awesome. So thank you all for being here. Mark is here as well. Hello. Regan Place is good. Arpine is hello. David. So cool. Glad you're joining me on YouTube. It's so awesome to see you here. Let me look on Facebook, see if everybody's here. We got 10. We got Bobby. Dominique is on Facebook as well. And so welcome to all of you. My name is Chad Carson, and I go by Coach Carson online, and I recently wrote a book for BiggerPockets called Retire Early with Real Estate. And so that's the topic I'm going to kind of drill into today, specifically about the math of early retirement, about the big picture numbers of what it actually takes to retire early. And so just to give you a little brief background on me, I want to hear from you guys and talk to you. I'm going to talk about 15-20 minutes about this on the whiteboard and do some little brainstorming and simple math, no calculators. And then I'll stick around and open up to questions and answers if you want to ask me things about what I'm doing, or if you want to talk about other things in your business and your real estate investing, that'd be awesome. So just to tell you a little bit about me, I've been investing in real estate for 16 years. I'm 38 years old. I live in Clemson, South Carolina, which is kind of down in between Charlotte and Atlanta. It's a small college town. And so I own multi-unit properties, small multi-unit properties there, single family houses as well. And my story, though, is that I started off flipping houses, wholesaling, and I got into rental properties eventually. That was kind of my long-term goal, and have used those to produce income, and I live off my rental income. So I want to tell you that just because when somebody's talking about this stuff, it needs to be, hopefully there's some credibility that you're actually doing this. So that's what I do, and my wife and I have two young kids, a 5 and a 7-year-old. And we just got back from 17 months living in Ecuador and traveling and letting our kids go to school there to learn Spanish. So that's sort of my thing. Everybody's got their why that motivates them, and so that's mine. And so I'm always been doing real estate investing since I got out of college. This is what I do, and so hopefully I can share some tips with you on using real estate to retire early. That's what my book is about, and it's such a new book. I don't even have a copy of it. I'd love to share it with you, but it's out on BiggerPockets. You can order it there. And so let's dig into some of the math. And the reason I think it's important to have at least a big picture goal of what it takes for you to live off your rental income or live off your real estate it's not the most important thing. Like, the most important thing is you actually taking action, making offers, doing the day-to-day stuff, all the things you hear about on BiggerPockets so much and discuss. But the big picture math is important because it's sort of a target or a goal that you're shooting for. And hopefully I'm going to show you also to make it more real, to understand like what's it going to take for me if you're just starting or if you're kind of early in your real estate career, what will it actually take for you to retire early, to use your rental income to do something else. That doesn't mean you have to retire from your job, doesn't mean you have to quit working, but not having to have the job to make the income, what does that look like with real estate? So here, there's a couple, I want to first mention, before we get into like the real estate math, traditionally, if you were doing retirement planning or thinking about how like stocks and bonds and other kinds of things were going to pay for your lifestyle, typically there's a kind of a rough number. This is a kind of a rule of thumb that applies for most of the time. People would tell you that if you, for example, needed $100,000 per year in income to cover all your expenses, and that might be a lot higher than you need, might be lower. We'll just use that number because it's simple math, right? Typically, they would say you need about 25 times that. So 25 times $100,000, which is $2.5 million. You would need to save up or accumulate wealth of $2.5 million in order to be able to live off of your investments for a reasonable period of time. And that's like the corollary of the 4% rule, if you've ever heard of that kind of thing. But the point is, that's just a rough number. And the real estate math is a little bit different. And so I'm going to go over 3 variables here that are important, and think about these as real life things. This isn't just math. I want you to think about like what are the amount of expenses that you need to cover in your life, in your family's life. This is just the bare bone basics. Like, what would I just need for my bare bone expenses, covering your medical insurance, covering things like, paying for food, paying for the basics. Just kind of get a bare bone number. And so think about what those expenses would be on a yearly basis. And then also think about like, all right, what if I padded that and I had some luxury items and eating out and traveling and having a cushion for health insurance and other things that could change in the future? What would those numbers look like as well? And so keep that in mind, because that's going to be part of the math. What is your number, just roughly? So is it $50,000 a year? Is it $100,000 a year? Is it $200,000 a year? I actually did an interesting survey as part of writing my book, and I asked 851 people that question. And tell me, we're chatting here, so like, what do you think? What would you guess the average amount of expenses that people needed to cover in retirement, or they told me they wanted to cover with their rental income, with their investments? Like, just let me know on Facebook, YouTube, and on BiggerPockets what you think that number is, and then I'll tell you the real number, because when we run the math, we'll actually use that number to figure it out. So I'm going to look on Facebook, see what some of you say there. There's Arian Shihai. Hey, Arian. Glad you're on here. Nancy Sumners. Hey, Nancy. So somebody said 3,000, so I'm assuming 3,000 a month, like 36,000. Brock says 40,000 a year. Eric says 35,000 annually. Good numbers. 50,000. So we're all kind of, on Facebook, we're hovering around like 30 to 60,000 bucks a year. Let's see what YouTube's saying, what you think it is. So 40,000 is what Gamma Fighter said. Trey, you said 50,000 bucks a year. Jason, 50,000. Nick Leather said $100,000. So, this is a personal number. Like, you don't have to, compare yourself to one person or another. But the fact is, we all have kind of a range there. And what I found, though, surveying people, that I gave them ranges, and between $50,000 and $75,000 a year was the median, and also the average number that people gave me. So some people were 200,000, 250,000. Some people were 30,000 bucks. Like if you read Mr. Money Mustache, or some people who live like very frugally and happily, there's a range there. So we're going to be doing some math with some of those numbers, but just keep that in mind. What are your expenses? And then also we're going to be talking about, with real estate, what kind of cash return can you get on the wealth that you have invested in real estate? Is it 6%? Is it 10%? Kind of think about that number a little bit, a cash on cash return. And then the amount of wealth that you have accumulated. So those are the three basic variables. I'm going to give you two different ways to run your numbers for yourself. But let's run the numbers with that first. And so let's say, for example, let me erase some of this. Yep. So we can actually do the math there. Hopefully you can see this okay. Let's say your number is $70,000 per year. So that's the expenses that you would need to cover in retirement. And let's say you could get a 10% cash return on any of the wealth that you had invested. So here's the formula that I would use. I would have E, so my expenses, divided by R equals the amount of wealth that I need to have. So $70,000 divided by 10% would give me the amount of wealth I need to accumulate in order to have it to pay for my expenses. So 70,000 bucks. Now that's gonna be really small. You're not gonna be able to see that. But 70,000 bucks divided by 10% is, drum roll please, $700,000 in wealth. Hopefully y'all can see that. So super simple. And the point here is not to be like really precise. The point is that, remember, to have like a rough target as you start accumulating properties or building wealth or building whatever way you're using to accumulate wealth. It's that little simple math, and you just kind of back of the napkin kind of math. Why do we do that? Again, we have to know, like, are we almost there? Are we halfway there? Like, let's say if you did this math and you said 70,000 is my number. I think I can get 10% cash returns on my properties, and that's right. And you looked and you were starting real estate and you had $350,000 saved up already, or you had equity in real estate that was $70,000 or $350,000. You would be about halfway to your number, roughly. And so that's sort of how I use it. I use it, am I at the bottom of the mountain? Am I at the very beginning? Am I halfway up? Or am I really close? Because if you had $700,000 and let's say you had it invested in stocks and other places, knowing these kind of numbers, you could then say, all right, it's reasonable that I could perhaps invest it. I'd have to go and find the properties and make sure I got them correct, good properties that I can manage well. But it's reasonable to think that real estate could pay for my expenses. That's the point of this kind of very, very rough math. And so you could do some variations on this. You could say, all right, 10% is too aggressive for me. and also I need $100,000 instead of $70,000. So let's just do another example with $100,000 and 6% interest. So let's say you were a little more conservative and you said, you know, with that much money invested, I'm going to only be able to get 6% cash return. You know, what would the numbers look like in that case? Anybody want to throw out a number? You got your little calculators there. You want to do the math for me, and then I'll see who got it. So, see, I saw Jason was making a comment here on YouTube. Let's look on Facebook real quick. Yeah, so I'm still waiting. Got a little bit of delay on the response, but y'all do the math on your own numbers as well. But if you needed $100,000 and a 6% cash return, then you'd have about 1,670,000 would be the equity or the wealth that you need to build in order to cover $100,000 a year at 6%. All right, so yeah, y'all, you got the number. Reagan already had the number 1.757 million. Will Henderson had the number 1.6 million. Somebody made the comment to me earlier. Ana Lucia Perez said 20,000 if you live in Ecuador, right, Chad? Absolutely, yeah. We actually lived we were living like kings and queens when we were there in Cuenca, Ecuador, and we were about 3,000 a month, so 36,000 a year. I think we could have done better if we were trying to be a little more frugal, but we were enjoying ourselves and having a good time and traveling to the Galapagos. So yes, the amount of expenses are really going to depend on your particular situation. But one thing to keep in mind, because this math is what it is, if you want to retire earlier, if you want to reach financial independence earlier, there are only a couple variables you can affect here. Like one is, what if you needed $50,000 instead of $100,000 to cover your basics? Like, what if you could be happy and leave your job if you just had $50,000 instead of $100,000? What would that do to your math? Well, all right, let's do that. Let's say $50,000 using 6% cash return. So we want to cover $50,000. We get the 6% cash return. How much wealth would I need to have in this case? Drum roll, please. It would just be half of what I just did. So I'm going to do rough numbers. I think it was $830,000 or so. I probably didn't do that exactly right, but the point is, like, if you can be happier with fewer, with less income, you know, you could have half the wealth that you'd have to build so that you can then get there faster. And that's kind of what the scenario I'm in. You know, I still have future goals. I still want to accumulate more wealth. I'm not like sitting on my laurels completely, but I reached a point where I had just our basics covered, and our family can live between $3,000 to $5,000 a month, like our base expenses. You know, $3,000 a month. We can live very comfortably for $5,000 a month. We're in the South. We're in a low cost of living area. I know some of you are in different places, but something to think about is, like, can you move to other places that are less expensive and still be happy? Because the math doesn't lie. You know, you have to accumulate a lot more money to pay for your expenses the higher you get. So there's a couple questions coming in about the math. So this will, I'm not sure, is this going to be recorded, Sonny asked. And I believe you can. On YouTube for sure, it's going to be recorded, and then I think Facebook as well. So you'll be able to watch it later and go back over it. And I know math, sometimes it's easier to rewind that and listen to it again. And so Joshua Darville just jumped on. He said, what's the formula? The formula is E divided by R equals W. So your expenses divided by the cash return that you can get from on your real estate. So the cash return on your wealth invested equals the amount of wealth you have to have total. And remember, the reason we're doing this is to have a rough goal on where are you going with all this activity you're doing in real estate. Like, where do I need to get? Am I halfway there? Am I quarter way there? Am I 3/4 of the way there? So very, very rough math, but I'm hoping you're seeing that there's some value there. And going back to my scenario, like me being able to cover, my wife and our family being able to cover $3,000 to $5,000 a month, so $36,000 to $60,000 a year, was a much smaller amount of wealth we had to accumulate than if we had gone a traditional route. Like if we had gone and we had to, remember the 25 times rule earlier, I would have to have $1.5 million, $2 million in many cases to cover some of those expenses. So real estate, one of the big benefits is it produces more income than some of the other equivalent places you could put your money. And when you're retiring early, when you're living off of your wealth, the income is everything. Like that is what you want to, that's what you live off of. And so getting a 6 to 10% return on your wealth is a very doable achievement within real estate. You're going to still need to hunt for deals. It's not just going to plop on your lap, but finding those and finding the right properties is definitely a doable thing. That's what you watch on BiggerPockets. That's the kind of things you learn to find those kind of multi-family properties, single families in lower price ranges sometimes, that could actually do this and produce that kind of income for you. All right, so let me see if there's any questions before I'm going to move on. I'm going to show you a little bit different way to do the same thing using real estate, and we're doing the math of how you figure out how much wealth you need. So let me give you one other, perhaps even simpler way to think about this. All right. So in this case, we're still thinking about how much income we need. So some of you said $100,000. Some of you said you needed $50,000 a year. Some people need 200. So all of you have that number in mind. Just think about what that number is. So we're still going to start from there, but I'm going to give you a little bit different way of thinking about it. So let's say that you could buy a property, and let's just say it's a duplex. So you could buy a duplex that rented for $1,200 per month. So $1,200 per month is the gross rent. That's the total amount of rent you could collect. And let's say your expenses, after paying your management, taxes, insurance, vacancy, capital expenses. We all remember capital expenses, right? You have to replace your roof. You got to replace the driveway eventually. So there's going to be some expenses ongoing, like big expenses over time. And so what would it look like if our expenses were $600 a month, and that's not including your mortgage payment, and that's important in this example. So I'm gonna assume that at some point I had these properties paid off. That sometime in the future, and just bear with me on that, why I'm saying that. At some point in the future, you've got these properties paid off, and so you don't have a mortgage expense. Might be 5 years out, might be 10 years out, but down the road, you don't have a mortgage expense. So you collect $1,200 a month, you pay $600 a month in all your operating expenses, and so really complicated math, how much do we have left over? $600 per month. That's our net operating income, $600 per month. On a yearly basis, times 12, that equals $7,200 per year, right? Okay, let's let that sit for a second. So if you have one property that can do that, can produce $7,200 per year, how many would you need with whatever your financial independence number is, whatever your expenses that you needed to cover? So it could be pretty simple. What if you needed $70,000 per year? How many properties would you need if each property produces $7,200 per year and you need $70,000 per year? How many do you need? What's the math on that? 10 properties. And so you can go up or down depending on how many you need. If you needed $100,000 a year, you need a few more properties. If you only needed $40,000 a year or $35,000, you might be able to get by with 5 properties paid off free and clear. But I like to start with that math. You may or may not choose to own your properties free and clear. That's like a hot debate always on BiggerPockets, is like whether you should pay your properties off, whether you should keep them 100% leveraged, or whether you should do something in between, which I'm sort of in that camp at the moment. I've got a good number of our properties paid off so that they increase the cash flow, so that we have lower risk in case we hit something kind of choppy water in the future. But I also keep some properties with leverage. But the point is, if you kind of start from there, let's say if your goal is to do a BRRRR strategy where you buy some properties, you remodel them, you refinance them, you get them rented out, and you just accumulate for like one period of time. So maybe 2 or 3 years, you accumulate properties. And then you get to your number, you get to 10 properties and say, all right, I'm good. I've got my 10 properties. And then what if you decided to have like phase 2 is concentrating all of your income. So all of the extra cash flow from your rentals, all the extra cash flow from your savings from your job. What if you concentrated all that on paying off these 10 properties after you accumulated them for the first 2 years? It could probably, if you do what's called a debt snowball, which many of you have probably heard from like Dave Ramsey and kind of personal credit card paying off debt. Well, you could do the same thing with rental properties if you wanted to, and you could concentrate all that cash flow and get 10 properties paid off if you were really disciplined within 8 years, 12 years. It just depends on how much you're paying down and what your loan details are. But the point is, and like the bigger picture of all this, and what I wrote about in the book, is that there are strategies to start with nothing, invest your money, like have a big picture goal like this, And within 10 to 15 years, it's very reasonable to get to a point like this where you would have 70,000 bucks a year coming in from your rental properties, and you'd have a really simple portfolio, like in this case, 10 properties. And I can just tell you from my personal experience, and maybe some of you could chime in who are also landlords on the stream here on Facebook and YouTube and on BiggerPockets, like, is managing 10 properties, if you had a third-party manager, if you had some systems, like, how much time would you have to take if you had to manage 10 properties? Like, would it be 20 hours a week? Would it be an hour a week? Would it be 30 minutes? What do you guys think? I'll tell you, like, my real numbers with more properties than that and how much time I spend every week. But what do you think you would spend in time if you had 70,000 bucks a year coming in, you own 10 properties, and you had a third-party manager helping you out there? How much time would all of you spend? Because that's really what it comes down to, isn't it? When you're living off your investments, what else do you want to do with your time? Like, time is the ultimate currency. That's the thing that we get to use either to travel, like in my case, spend time with your family, start a new business, quit your job that you're in right now. That's what we're doing this for in the first place. And so I've got some answers here. So an hour with property management, Chris Edwards said about an hour per week. I think that sounds pretty right on. Somebody says 10 hours a month. That could be right as well. A couple hours a week, maybe 2 hours a week. Eric Perks has 5 properties and a manager, so probably an hour a week. Joshua Darville on Facebook says 4 hours a week, like Tim Ferriss, 4-hour work week, right? I think we need to one-up Tim Ferriss and do like the 1-hour work week. Let him know that real estate can be even more passive. Facebook, let's see. Let's go to YouTube. YouTube, see if anybody's answering on that. A few hours a month was the answer. A few hours. Okay, so I think for most of you who are already managing properties, and I'll tell you my experience. Like, when I was in Ecuador, I was in another country, and so thousands of miles away. There's no way I could go in person and do anything. Like, I had to depend on other people on the ground, and I have 90 units in my case between me and a business partner. So we're 50-50 partners, and I usually spent an hour or 2 per week doing things like I still paid my bills, like for contractors, because I just wanted to know what's going on and how much I'm spending. And also, just checked in. I did some bookkeeping myself. I still like to do some of that. Just again, like watching the numbers. Like, doing your bookkeeping is kind of like keeping a pulse on your business. Like, you want to know where the cash flow is going, where the money's going. And so I would do that. And I spent an hour or 2 per week. And so going back to our example, like, if this is your retirement plan, this nice little simple plan to own 10 properties, to pay them off, and to make 70,000 bucks a year, and to do it in the next 10 to 15 years, if that's your plan, not only will it help you financially, succeed financially to pay your bills, but it also is very reasonable to think you'll have enough free time to enjoy all that money. And that's really the theme of what I wrote the book about. It's a theme of what I'm trying to do in my own life. I'm not always perfect with it, but is like rethinking the idea of retirement and saying, all right, once you have retirement taken care of, once you have your financial independence taken care of, or you're on the way, like, what's next? Like, what do you want to do with your life? What matters to you? How can you change the world? How can you influence other people positively? Part of my answer is being here with you. Like, I'm having fun with this, and this is a really good time for me. And so, like, getting to share it with you, like, I could go out and try to buy, like, I have 90 units, and I've been doing this full time for 16 years. I could try to go syndicate and buy 1,000 units and go 10 times everything. And like, that's cool. Like, people who want to do that, that's awesome. And I'm glad there's people who do that because other people can invest with them. But for many of us, like what I've found on BiggerPockets is a lot of us are going to be totally happy with two units, 5 units, 10 units, 20 units. And I'm just trying to validate that the math works if that's you. Like, don't think you have to be like the 100,000 units and take over the world kind of person. You can completely live an awesome life. You can make plenty of money. You can travel. You can be more with your family. You can do some really cool things, and not have to have an enormous empire. And so it's up to you, whether you get 1,000 or whether you get 10. It's your math. It's your life. It's your numbers. But I hope the general math here kind of helps you out, helps you think about it. Whether you do work it backwards with the number of units, rental units you want to have, or whether you do the formula, which for those of you who just joined me, let me leave that formula up there for you. E divided by R equals W. So expenses divided by your cash return equals wealth. Yeah, can't read that, can we? Wealth. Trying to write. All right, so that's the math we did today. That's very simple. I like it simple that way. I hope it's been helpful for you. And I'm here for questions. So I've talked enough, about 25 minutes. I'm so happy that the sound worked because I thought I had a jinx on me for doing live streams and talking. But I'd love to hear from you. So I'm going to look on YouTube here. I'm going to look on Facebook. And let me know how this landed with you. Like, is this helpful? Is there any other additional questions I could help you out with? Do you want to ask questions about my business, about what I'm doing? Boston Beauty said, why are these lessons going on during work hours? I don't know. Yeah, might be disturbing the peace a little bit with talking about retirement and not having to work. But, you know, that's motivation too, right? It's like, let's get these properties, let's buy them. Let's get these properties producing income so you can live off of them. Or even getting like your properties to the point where you have half of the income you need is a big deal. And I wrote about that in the book, how you can set little sub milestones. Like maybe your number is 60,000 a year, but when you get to 20,000 a year and 30,000 a year, like those are really helpful too. You could go work a job that makes less money, but you love, instead of having to like do something that just makes the highest dollar. You know, wherever you are in the path, whether it's one property or 10 properties or a lot, you know, it can always set you free kind of in degrees. And that's certainly what I found. I've taken a lot of mini retirements and trips. Like in 2009, before I had the full amount of income that I wanted, I still took trips and was able to have a lot of freedom and flexibility because I'd already bought some properties and was doing pretty well. All right, let me see if there's any other comments. So Bryce Harrell has a question on here on YouTube. Does this factor in selling or acquiring more rentals a year once in retirement? Good question, Bryce. So I'm not counting in this simple math. No, I'm not counting on having a buy-sell business or buying additional units in retirement. I'm just starting with like a really super basic number of like, what would my rental income produce beyond if I didn't do anything else? But I think kind of reading behind your question a little bit is like most of us who are ambitious enough to take the time to build up your wealth and buy these properties and pay them off. Like, what are the chances that we're not going to buy an extra unit every year or have a little side hustle that makes some extra income? Like, I would say, especially if you're in your 30s, 40s, 50s, even 60s, like the chances of you making an extra 10 grand a year, 20 grand a year, just doing something extra is very likely. And so you're not always going to, that's why I think personally, my approach is to sort of get a bare bones number here doing this math. And say, I want my rentals to cover like just my basics, my basic expenses, and then start with that. So if your basics are $3,000 a month, like get there first, and then maybe you shoot for a bigger number from there. But like just getting to that bare basics number might allow you to leave this job you don't like, and then you could go flip a house every year to make an extra 20 or 30 grand, or you could become a realtor and have a license and make money that way, or you could sell stuff on Etsy. Like there's so many. And today with the internet, I mean, there's so many side hustles and ways you can make an extra 10 to 20, 30 grand a year if you had the time to do it. But most of us don't have the time because we're working the job, because the job is our security blanket and pays us money. And so what we're talking about is building a new security blanket using our rental properties and our income from those properties so that you don't have to depend on clocking in at a job. It gives you choices and options. So love that question, Bryce. I'm going to answer a couple questions on YouTube. Then I'm going to go back to Facebook and BiggerPockets. I've neglected the BiggerPockets live stream, so I'm sorry, guys. I'm going to go back and look at the chat there as well. So Boston Beauty says, thank you, guys. Thank you for being here. Osvaldo says, do we need a career or have good income to start buying rental property? Typically, it helps. Like on the level of easiness for getting started with rentals, like ideally, like plan A would be you have a W-2 job where you make good income, meaning you have documented income that you could then go use to get a loan with a traditional mortgage company. Like if you have that, if you have regular income from a job, that's actually an asset for you when you're first getting started buying your first few properties. If you don't have that, which I did not, like I got started when I was 23, right out of college, and I just jumped into this thing full time, just trying to buy and sell properties. And so like I was not bankable at all. Like me going to a bank was kind of a joke because they would look at me and say, you're 23 years old, you're a biology major, you have no real job and you want to get a loan to buy real estate. Is that what you're telling me? And I would say, yes, it is. And they, I got one or two loans, but for the most part, I had to use more creative financing and seller financing and private money from other people. So it's easier if you have the job. You can go to the bank and get a loan, but you have to kind of start with wherever you are. Wherever you are, there's a way to do it. You just have to understand the challenges one way or the other. All right, one more question on YouTube, and then I'm gonna jump over to the other ones. So Josh Ross says, I have one property producing 2%. Market is really high where I am, and I have a ton of equity. Do I sell and run with the money, or do I stick it out and keep renting? That's a good question. So Josh he has a really low cash return right now, but he has a property in a higher market, and so it's a little tricky without knowing like the entire picture, Josh. But the question I would ask you is, how far are you up the mountain? Like if you ran your numbers and you said I need $1 million and your equity right now is $950,000, like I would be more likely to cash in and like turn that into some income. I might sell that property and then do a 1031 exchange and try to buy like a really good multi-unit property or something that produces an 8 or a 10% or a 12% cash return, because in that case I'm done. Like I've met my milestone. But if you find yourself in a point where you're halfway there, a quarter of the way there, it's a little bit trickier. Like, what's the future potential of that property? Are you paying the loan down really quickly? Is the market rising? Like, there's just some other factors you'd have to look at. And that goes down into a lot of the things I covered in the book. Like, what's your strategy to actually build wealth and actually get to the point where you can live off your income? Because there's several different core strategies. There's some that you just buy an income property and then get the best income you can, and you retain all of that income and use it to either pay down loans or buy your next property. That's sort of a cash flow centric wealth building retirement plan. And that's viable, but it's not going to happen in San Francisco or Seattle. Like you're not going to get really high returns, and so that's going to be a little bit more difficult there. So in your case, if you're in a higher price market, you can actually make a lot of wealth, but you're not focusing necessarily just on the cash flow. You're focusing more on the growth of your equity. So you might be focusing on, can I buy and sell? Can I buy properties below value that I can get 50 or 100,000 in equity in this property within a few years? Do a 1031 exchange and then buy the next property and do that 2 or 3 times. Like that's more viable when you're in a higher price market, because you're getting appreciation, and that's not guaranteed, but you can leverage that appreciation. You can use it. You can use the fact that your market is very liquid and you can sell it easily to compound your money by buying and selling a little bit more. And so there's, in the book, I give a lot of examples. I had 24 case studies, and it was so fun for me because I kind of did it one way in my market, but I wanted to see, like, how do people do it in Manhattan and New York? And how do people do it in San Francisco? And how do people do it in Houston, Texas? Shout out to Arian Shihai, who's a friend of mine and really good at this stuff too. So like everybody had like different strategies, but there were some core principles. They all did some basic math. They all had to save money and invest it in real estate. So I tried to share like the common principles and then the variations on those common principles and how people applied it. That's what I found very interesting, because all of you have a unique story. Like you have a unique situation, a unique market, and so you need to figure out how to apply the principles to your local market, to your particular situation. Thanks for the question, Josh. Let me jump over to BiggerPockets and the live stream there. Guys, I've been not listening to you over there, so let's see what you got. So we have, let's see who's on there. Kajel Runer said, did you grow your portfolio using the BRRRR strategy? And also, where in the country do you invest? Cheers from Norway. Awesome, thank you. Thanks for chiming in from Norway. So I built my portfolio partially with the BRRRR strategy, yes. So for those who don't know, I think I explained it a little bit earlier. Basically, the BRRRR strategy is a way of using leverage early on, where you buy properties that are fixer-uppers, you buy them kind of at a low price, you fix them up, you get them rented, and you just use cash or private money or any kind of money you can in short run to get it fixed up and rented, and then you refinance it with a long-term mortgage and pull some of that working capital, that cash, back out. And so I certainly use that in many cases. But it wasn't my only strategy. I kind of combined a few different ways. I did that because I didn't have a lot of money up front. Like I got out of college and had about $1,000 in the bank. And so the other strategy I used was just buying and selling properties. Like I did a lot of that early on, and so I would just flip properties like in 3 to 6 months just to generate cash flow, both to pay the bills and also to save money for investment. But I quickly learned that like that's not the most tax optimized strategy. So I would try to flip as many houses as I could just to pay the bills. And let's just say that's like 2 properties a year. Like I would flip 2 properties a year, pay my bills, keep those expenses low. But then as quickly as I could, I started doing some buy and hold properties where instead of me flipping a house, I would keep that house for 1, 2, 3 years. And then I would increase the value, I would do something to the property, and then I would sell it after 2 or 3 years. And it was a better tax strategy for me because I paid long-term capital gains in most cases. And that's, right today, that's between, depending on your tax bracket, you're international and from Norway, so it's a little bit different in your case. But in the US, the tax brackets on long-term capital gains are much lower in some cases than if you just earn the income. So it was anywhere between 0 and today 20% is the capital gains rate for long-term sales. So I was able to use lower tax rates to compound my wealth. So we would sell it, get some money, put that into the next property, and grow that way. That was my primary growth strategy. In addition to BRRRR strategy, and in addition to, I did some debt snowballs as well to get some properties paid off a little faster. Great question, thank you. Let me check in on Facebook. Is anybody still with me on Facebook? All right, let's see. I see Eric's on there, and hope just jumped on. Joshua did. Okay. All right, I'm going to look at these. I'm going to go up a little bit because you guys are having an awesome conversation here. All right, so Rick Bergen says, what are your strategies for increasing your R? So the cash return part of that equation. What's then your strategy for increasing that rate after the rental's mortgage is paid off? All right, so that's a good question. The type of property you invest in is going to determine like what that cash return is on your investment. So, for example, if you buy a single-family house in a high cost of living area, so I'm just thinking Seattle's on my mind for some reason, but if you buy a single-family house, and even if you paid cash for it, these days you probably get like a 2% return. I mean, a 2 maybe. Yeah, I don't know the exact numbers there, but 2 or 3% return. So that's a very low end. I mean, you could get treasury bonds right now, meaning like zero risk, kind of 5 to 10 year treasury bonds at 3%. And so people are paying like, if you buy some properties in really good locations, people are doing 2 or 3% cap rates right now, which is super, super low. If you buy more commercial properties, or by what commercial I mean more business-oriented properties, single family is kind of an interesting animal because people live in them, but we can also own them as investments. If you start getting into duplexes, triplexes, quadplexes, and definitely into like multifamily properties, it's very reasonable to think you could get a 5 to 10% cap rate. So the R, if you owned it free and clear, R would be your cap rate. And so it'd be reasonable to think you could do that. And so one way of increasing your R in this case is maybe upgrading to a different kind of property. Like maybe you had a single family house to start off and it's appreciated so much that your R is really low on your total amount of equity that you have. And so maybe your strategy is to sell that property. And I call this like reshuffling your chessboard a little bit. Like I've been doing this with our portfolio, is looking at which properties are not performing as well or don't have as good a future potential. And then I might sell that one off. And in my case, I'm doing a 1031 exchange, so I don't pay taxes on it. And I get a replacement property that has a better location in many cases for me, but also hopefully better cash flow. And so that's part of optimizing your portfolio, is looking for properties that you can, you're looking for 2 things. I want to emphasize that. Like R is not everything. Like your cash flow today is not everything, because sometimes the better locations and the better properties don't have a great R, don't have a great cash return right now, but they might be the best investment over the next 10 years because the rents might go up and because other things might get better. So you need to balance like the qualitative, like location factors, and is this a really good location with demand and good demographics, with what the current income is, and balance those two. And today with lower cap rates and lower interest rates in general, it's a little tougher. Like that R part of the equation is the tougher part. And so you got to be more diligent in finding little niches and little areas where you can do better and buy with better cash returns if that's what you're doing, if that's your goal. Okay, that's a good question. All right, so Jenny Zeppel asks, what kind of down payment and emergency fund would you recommend a first-time buyer have? I'll just give you an example of a property my wife and I bought. We have a rental business. I have a business with a partner, and we also have a couple properties that my wife and I own on our own. And when we made a little bit smaller down payment on our residence in this case, and so I think we paid. No, I'll take that back. We had about 25% down on our property. And I'm not saying that's what you have to do, but if somewhere between 3% if you get an FHA loan up to 25% is kind of the down payment range. And there's some arguments for doing a smaller down payment and just getting in the game and just making it happen. Like I would make that argument if you also have a good cash reserve. And in my case, like when I first bought a rental property with my wife, in that case, we set aside $5,000 for that rental, and the rent on that property was about $1,000. So we set aside about 5 months of rent in case we didn't have any rent coming in case something happened, in case the heat and air broke. And that's really what that cash reserve is for, Jenny, is you want to make sure like you're getting into this with a lot of leverage in some cases. If you put 5% down or 20% down, like you just want to know that like if I have a heat and air go out and it costs me $3,000 or $4,000, I'm not having to eat into my personal reserves or not have the money and not be able to fix that for your tenant. So it's kind of a personal decision on that, how much cash to set aside, but I like to measure it in months of rent. So usually kind of like when you do a personal emergency fund, you want to have 3 to 6 months of your expenses saved in a personal emergency fund. Yeah, I like to do the same thing with rental properties. Like take 3 to 6 months of your gross rent, set that aside, and have that be sort of just a rainy day, whatever happens kind of fun. That's what I do both personally and in our rental property business as well. All right, really good questions in here. Awesome. Arthur Benoit. I know Arthur Benoit. Went to high school with Arthur, if that's the same one I'm thinking of. Hey, Arthur, good to have you on here. Tony Bellisback says, how do you take money out of your company to pay yourself without getting hit with the taxes or the way to go about it? So like if you had an LLC or S corporation. All right, we're talking taxes. Like taxes is the only thing probably after math that gets people's eyes glazing over sometimes. I know that, so I'm gonna try to keep this as interesting as I can. But like the way I own most of my properties in an LLC and also own 1 or 2 individually. And so in those cases, like there is when you make money in LLC, there is not like a C corporation where there's a tax paid on that money separately from you personally. Like when you own an S corporation or an LLC, like you pay taxes on that money just as an individual, meaning sometimes they call that a flow-through entity. So like if you made $10,000 in your rental property, like that goes right to your Schedule E or one of the other schedules on your personal tax return. And so the question of how do you take your money out is just how much you want to distribute to yourself every year. Like my business partner and I just have a set distribution, sort of like a dividend that we pay out every year or every month. And so it's kind of like just replacing a salary, just to have something steadily coming in. And every once in a while, if we have we have some big sales or we decided to take some money out, we could take out like a special check and just write a check out of there. But it's as simple as that. We just do a direct transfer from your business to you personally. And the taxes are already paid in a separate place. Like it's not like a W-2 income where you have to do payroll or something. Like when you own the business and you own an LLC and that money's distributed, you report that on your tax return for the business at the end of the year. But it's not as complicated as doing it like payroll and that sort of thing. But you do have to watch your taxes, and that's a big conversation about like what's the best entity for taxes. And but that's probably something more than we want to get into at the moment. I hope that helps out a little bit, Tony, if that answered what your question was. All right. So Eric Perks said, did you buy or did you rent when I lived in Ecuador? So for those who just joined us or got in late, I lived in Ecuador with my family for 17 months. We just got back a few months ago to the U.S. And we actually just rented. Like I had people down there, it was really fun to look at real estate in Ecuador. Just felt like a Wild West in some ways, just totally different from what I'm used to, which was fun. But we just rented, and if you like real numbers, I always like to know what people paid. Like we were in a city called Cuenca, Ecuador. It's about 8,000 feet up in the Andes Mountains. It's the 3rd biggest city in Ecuador. Beautiful old buildings and nice parks and rivers. Like we loved it. We're going to go back and visit because we have so many friends there now. But we lived in an area that was very walkable, kind of close to town, and one of the nicer areas in town. And we paid $600 per month for a 2-bedroom, 2.5-bath apartment. And that included utilities, that included our furnishings, that included everything. So if we had lived there for like 2 or 3 years and we wanted to get a long-term rental and not have it furnished, I think we probably could have rented the same thing for maybe $500 a month or $450, somewhere in there. And if we wanted to live farther outside of town and not such a good location, you know, $200 or $300 a month was possible. And this is one of the most expensive cities in Ecuador. So just to give you a perspective for any of you who are thinking about traveling outside the country, your money goes a lot farther, both with housing, food. We would load up on like this mountain of beautiful, delicious vegetables and fruits and local exotic fruits that we'd never seen before. And for $20, we would have this table full of fruit. And so it was really interesting to go, they call that like kind of global arbitrage, to live somewhere else and actually live off dollars coming from another country and live off that and use those dollars in a foreign country is very helpful for those of us who have dollars coming in. It's nice, and we were spending our money there and hopefully helping their economy too. All right, Chris Edwards is in, I think, Greenville. Hey, Chris, do you have any banks that you recommend for the Greenville, South Carolina area? I'm looking at a duplex for a possible house hack this evening. Also wondering if I should have a business account for the one unit I'll be renting out, or just wait until it's strictly an investment property. Okay, so you're gonna be doing a house hack and you're looking for mortgage financing. I don't have a like up-to-date kind of mortgage recommendation. I would go on BiggerPockets and go. There's a local group of a lot of South Carolina people and just ask what mortgage broker is hot right now, who's on top of things, because that just changes, and who's diligent and who knows the programs. And so I don't have a good answer for you on the mortgage. I use First Citizens Bank for my banking. And I do recommend early on for all of you, he asked me about when do you get a business checking account. And when you do a house hack, you're basically like dividing your life. Like half of that building is personal, half of it is a business. And you're actually going to treat it that way in your taxes. You're going to be able to depreciate part of the building. You're going to be able to have half of your tax expenses, or a portion of your tax expenses will be deductible, half of it won't. And so I recommend getting a business account and collecting your rent in that business account. It's super simple. I use Capital One 360 a lot for my business accounts, and you can, in a click of a button, you can set up a separate account, and easy, no minimums, anything like that. So it's super easy to do, and because it's so helpful with your accounting and tax returns, I think you should do it for sure. Hey Nick, I see you are on. He says great insight. Thank you very much. All right, so Catherine Garcia. Hey Catherine, we've chatted on Facebook but haven't talked, so glad you're here. So what's your advice for a newbie? Where do we start? Good question. I think what we've talked about today, like the big picture idea of like just figuring out like what's a rough number, where am I trying to go with this, is a good place to start. But very quickly, I would get into the idea of looking at your target market and understanding what's out there. Like I'm very big on like stop theorizing about it, philosophizing, like get out there and do something like today, like this weekend. And one of the things you can always do is go out and start looking at what's on the market right now, both for sale, for rent, what's available. And so I like to do like driving for dollars, or even better, walking for dollars. And that's where you just get in it, like look at a target neighborhood that you're interested in. And if you have a dog, like in my case, I had kids that I would push around in strollers, and I would get out in the neighborhood and just walk. Take a couple hours of just looking around, and you're looking for a few different things. You're trying to just get the feel of a neighborhood. What's it like to be there? And not just behind a computer, actually like being there. I like to physically be there if you can. And then I want to call for sale by owner signs, call or look on Zillow or some of the apps you have on your phone. Like as you're walking by a house, there's a listed house. Like what's that for sale for? Start just tracking it in your mind. Because as a real estate investor, like the number one value we add to the equation, a lot of the times where we make our money, is understanding the nuances of value in a neighborhood. And so it could like if you go in some neighborhoods, particularly in urban environments, like one street will be completely different than the next block over. And so you as an investor, like a new investor, if you could learn that, if you could just make one little like section of your town, like go dominate that, know it better than anybody, like know all the realtors who are working there, know all the property managers, like you should know every vacant house on that block or two. You can start there, and the good thing about that is you're not buying a house yet. There's not the pressure of having to go get the money and buy it. All you're doing is learning and studying, but you're not learning in a passive way like reading a book, although I wrote a book and I hope y'all get it. You're learning in a more active way, like in the market, and And so then when you go back on BiggerPockets and chat with people and they talk about numbers and running the numbers, you could go back to your notes and say, yeah, I saw a property today. Like I saw 10 properties that were listed for $300,000 bucks. And there's this one kind of fixer-upper house that was listed for $225,000. Like I wonder if that would be interesting. And so you take those theories and those formulas and the numbers we start running and you apply that to like real properties that you're actually looking at. And so that I would start there, Catherine. Like there's a lot of other places to start as well. There's other things you can do. You need to also start working on your financing. Like I'm not sure where you're planning to get the money, but if you're going to do a house hack or something like that, go talk to your mortgage broker or several mortgage brokers, get some quotes on money and how much it costs, what the terms are. And so if you get in the habit of getting the money, locking that down, and going out looking at properties both online and in person, if you do that consistently, you could do that like this week, and you might not know everything, like you might not have it all figured out, but you will be doing something that's productive and you'll be learning. So I would start there, Catherine, and then check back with me. Once you do that, like let me know how that goes and how your walking for dollars worked, and we can kind of go from there. Awesome. So we got more questions coming in. I'm happy to stay longer. Like it's been going for about 50 minutes. So if you want to jump in for another, if you want to go for another like 10, 15 minutes, keep on asking questions. I'm going to switch over to YouTube because I've not been focusing on Facebook here for a little while. And yeah, if you like this, by the way, I was supposed to do this at the beginning, forgot to do it. But like if you guys want to, if you like it, if this has been helpful for me, it helps BiggerPockets, it helps me. If you click on the thumbs up on YouTube, if you make a comment, if you like it on Facebook, if you share it with friends, like all that's is the payment basically for us providing this. So thank you for your help doing that. All right. So here's a question on YouTube from Homa Teramu. Says for the expense in your example. So I use this rental example where I gave income and expenses. You use the 50% rule, but not all the expenses. Is there any reason I use that? So what about the rest of expenses? I understand what your math, what's your thought behind it? So I think he asked like why, and clarify me if I'm not answering it right, Homa. Like I use this number 600 as just a round number. And some of you might have heard of the 50% rule, which is a rule of thumb in real estate. If you're doing some really quick math on some rental properties, and you might look at a rental like this and say, all right, the gross rent, the total rent's $1,200 a month. And so there's like a rough estimate of expenses would be, let's just take half of that. So $600 a month is half of $1,200. And that's sometimes a good general estimate of what your operating expenses will be. And it's not always the case though, but when I'm doing simple math, I just wanted to make my examples simple, to be honest with you. But I run all the numbers on all my rental properties, and I've kept track of them for a long time. I have some properties that have operating expenses about 40% of my gross rent. So like in this case, 40% would have been about $700, or it would have been about $480 a month instead of $600 a month. So like that would be one of my better rental properties with a very low expense ratio of 40%. I have other properties, and these are some of the ones that I've sold in the past that had 60% expense ratio. So on a $1,200 rental, I would have had $720 a month in expenses. And so like I like the ones with a little smaller expense ratios. They're more efficient properties. They tend to do better for me long run. But the point is just knowing what it is. Like so you start off with simple math. Like you can use something like the 50% rule. That's fine. But when you actually analyze a rental property, you've actually got to break this down into the real numbers. So you got to look at the taxes. What are those? Look them up on the tax assessor site for your town, for your county. You've got to look at the insurance. You've got to get quotes or understand what insurance would cost. You've got to know what property management would cost. You got to know the vacancy rate. You've got to know the maintenance expenses, and you got to do an estimate for capital expenses. So I just listed off all of those things, which I just have in my head now because I've run the math so many times. But that's when you add up all of those. That's my assumption in this example that all those would total $600. So is there a rhyme or reason I use that? Simple math, easy, and it's approximately right for a lot of my properties. But in many cases, you might have less. You might have lower expenses, and in some cases, you might have more. So you need to really run the math on your own on all of your properties. All right, so good questions. Looking on YouTube some more. If you guys have a question on there, can you mention I like walking for dollars advice, Najee says. Thank you. Can you mention your book? So I will talk about the book a little bit. I told people earlier that I wish I had a copy of it. It's so new and it's on BiggerPockets. It's available right now that I don't have even a copy myself. It's shipping to me like later in the week. But the book is called Retire Early with Real Estate. It's the newest book by BiggerPockets. And it's all about, it's a strategy guide. It's some of what we talked about today, but it's looking at the big picture of saying, all right, I want to achieve financial independence. I want to retire early, whatever that means for you. How do I do that with real estate investing? And so I go through the strategies, and I have three core strategies for how people build wealth, and I unpack those like buy and hold rentals, debt snowballs, trading up, are three of the core ways. And I've mentioned those in kind of passing today, and I also talk about how the core ways you can start investing in real estate, like house hacking. I go into really detailed examples of that, the BRRRR strategy, and also what's my other live-in flip. So a lot of ways of using your residence to get started is one of my favorite ways. And so I share examples and I share strategies. So basically showing you like, here's a map, a roadmap to help you start and then grow your wealth. And so beyond that, I also had, I mentioned earlier, but I had case studies. Like I love looking at like real examples. And so I share my own example in the book, of course, but I also interviewed 24 other people who've used real estate to retire early. And then I use that to share like, all right, how did they do that? Like how many units did they have? What kinds of units? Where do they live? How do they build their wealth? And I interview them, ask them these questions. And so you can read these, you can read the strategy, you can look at the math, you can use that as sort of a guide for yourself. And then you can look at some of these examples and say, all right, that's how Mauricio, and he lives in Manhattan, that's how he did it. Here's how Sam out in San Francisco did it. Here's how Lisa in Virginia did it. And so I have people spread out all over in different situations, and I share their stories. So that's the essence of what the book is. It's for those of us who aren't just investing in real estate to like build this massive empire just to have an empire. Like it's for people who are doing this and want a tool to actually do what matters, like to spend your life like, you know, not working a job if that's your case for you, or traveling, or, you know, and do it a lot sooner than traditional advice tells you. Like you don't have to wait till you're 70 years old to retire. If you're in your 20s, you're in your 30s, like you could do this in the next, if you're super ambitious, you could do it in 5 years. If you're a normal ambition level, you know, 10 or 15 years, or if you just want to like, you know, kind of cruise 20, 25 years, it's very, very doable. And I give you a lot of examples on how exactly that works. So thank you for asking me the question about the book. It's available on, I don't have the link here, but if you go to BiggerPockets and go to the store, it's the first book available there. Retire Early is the big blue book with the orange letters. So if y'all like it, check it out. We had audiobook. I recorded the audiobook, so you'll get my southern accent and all if you like or don't like that. And then I also have the digital copy and the print copy too. All right. So Banjo asks, how did you acquire the next property if you don't have the 25% down payment? So I think this goes back to like, how do you grow your wealth when you're early on and your funds are limited, which they absolutely were for me. And so, you know, the ideal scenario would be, of course, you're saving money from whatever job you have. And so hopefully if you're making $100,000 a year at your job, hopefully you're saving 20, 30, 40,000 bucks a year in addition to your 401k. Like that would be an ideal situation. And I know that's not always possible for everybody, but you know, think about that first. Like how can I increase my savings just in general? Because then I can use that to buy the next property. But in my case, like I was moving a little faster, growing a little faster. And so I used leverage. First of all, I used the BRRRR strategy, which we talked about earlier. And basically what that means is if you can find a way to buy properties below value. So if you can find a $200,000 property and you can buy it for all in 150,000 bucks, including your purchase, repairs, all those costs, you could buy it, you could fix it up, you could get it rented, and then you could refinance it at, let's say, like 70% of the value of the property. So 70% of $200,000 is 140,000 bucks. So like if I had 150,000 bucks in it, I would only have to leave 10,000 bucks in that deal if I refinanced it at 70% loan to value. So that's a way you can buy a rental property with less than 25% down, is by buying a good deal, buying a fixer-upper. Beyond that, there's not a lot of tricks other than leveraging even higher. Like you could borrow second mortgages, you could do some, go on credit, borrow credit cards. I'm a little hesitant to give that advice because I think part of this is just the discipline of you just got to save the money. You got to work on it. You could partner with other people. That's something I've done early on. So like I was out finding deals, and so I was always finding good deals all the time. And so when I ran out of money, I would go to my friend and say, "Hey, friend, I've got this deal. Do you have money? Can we work together?" And so they would put the money up for the down payment, and we would figure out a way to split it as a partnership. And that brings its own complications, its own things you need to communicate with that partner. But I guess my point is, like, if you're good at finding deals, the money, you can find the money. But if you're not good at finding deals, like, you need to save the money and work on your credit and work on accumulating all of the things you need to do the deal on your own in that case. Good question though. All right, so we had a couple questions from Jacob Larson about how to use rental property to reduce my tax liability. I'm going to erase this a little bit, because that tax liability in rental properties is something interesting when you retire, and also when you're building wealth. One of the main ways is you're using depreciation. So depreciation, for those of you who don't know what that means, is when you buy a property, like you might buy it for $100,000, for example, and part of that property you buy is the land, part of it's the building, and so the building portion of that, let's just say like $100,000 purchase, let's just say 80,000 of that is allocated to the building, and 20,000 is the land. That could be arbitrary, but usually like your tax assessor or somebody will tell you like what the value of the proportion of the land and the building is. You can also ask an appraiser during your land. All right. And so the point is, with depreciation, how do you save some money on taxes? That building, the portion that's allocated to the building, you actually have to take a portion of that each year in a special expense called depreciation expense. So, and with residential property, that's 27 and a half years. So if you divided 80,000 bucks, and if there's somebody who has a calculator who can do that math for me real quick, 80,000 divided by 27 and a half, I don't know what that, let's just say that, I don't think it's 3,000, let's see. Yeah, it might be like 3,000 a year. So you would have 3,000 a year in a paper expense. It's not coming out of your pocket. You've already bought the property, but the IRS requires you to actually take $3,000 a year and call that an expense on your tax return. Now, what's the benefit to you is that if, let's say you made a net $3,000 in rental income, rental profit, net profit for the year, so that's your income, and this is your depreciation expense, you would actually offset all of that rental income with your depreciation expense. And so let's say your tax bracket was 40%. So you would have paid taxes on $3,000 per year, and what is that? That's like $1,200 in taxes. And you would save that because you're what's called sheltering some of that money using depreciation. So the general strategy, Jacob, and you might already know this, but by owning rental properties and producing a lot of your income from rental properties, you can automatically shelter some of that money using depreciation expense. That's one of the kind of core benefits of owning rental properties. The downside is when you sell that property someday, the IRS does something called recapturing that depreciation. So all of those tax savings you got along the way, you actually have to pay those taxes or pay a 25% tax rate whenever you sell the property, unless you do a 1031 exchange or some other kind of tax-free strategy. But that's kind of been a core part of our principle, Jacob, is that if you have 10 properties and you have $3,000 a month in depreciation expense, that could be $30,000 a year you could make without paying taxes on it. And if you add in a standard deduction for a family, so like it's a couple, we file taxes jointly, my wife and I do. We have currently a $24,000 standard deduction, I think. So if you combine that on the business side, that kind of, I have $30,000 a year in sheltered income there, and I have a $24,000 standard deduction. You can make up to, what is that, $54,000 in real money that you don't pay taxes on. So getting a head start with 54, like a lot of us remember we said 50 to 70,000 bucks is a number that worked for us. So you could actually shelter a ton of your income, not pay taxes on it. And if you only need 50 to 60 a year, you could probably shelter all of it for a long time until your depreciation runs out and not pay taxes. So in my case, like living off rental income, I have a very low tax basis compared to when I'm out buying and flipping a lot of houses, or if I had a high income job, I pay a lot more taxes. Like the tax the tax code benefits people like us who live off of investment income. It's a super good strategy just to do that, and then strategically sell when you need to. Somebody mentioned don't ever sell, just keep it until you die. I think that was Jason on YouTube. Yeah, exactly. Like if you don't have to sell, you just live off your income. And if you do have to sell, you do something strategic like a 1031 exchange, or maybe you sell during a year when you have a really low income. And so you might be able to get into one of those low capital gains tax brackets. So you can think about it and kind of think about it like a chessboard and be strategic about it. But good question. Taxes are a fun topic. Taxes are really important because that's one of the bigger expenses that's going to take your income as you grow. So if you can invest in a tax optimized way by buying and holding properties and renting them out, you can really increase the amount of income you save and also decrease the amount of time it takes to actually get to retirement. Good question. I've still got people with me. I'm loving the questions and happy to answer some more. Let me look on Facebook to see if there's any other questions. So Joshua Darville says, good info. This has been great. Thank you, Joshua. He asked where you can get the BiggerPockets t-shirt. I need to find that out. Like I got one. I don't know where I snagged it from. I think Brandon Turner and I were at somewhere, and he had a couple, or Mindy Jensen had a couple, and because I was on the BiggerPockets podcast. But I'm going to be doing another live stream, more regularly because the book's coming out. So would anybody be interested in doing like a giveaway? If we had a contest, you do the math first, or you chat or share this on your social channels, and we could do a giveaway of a t-shirt next time, or a t-shirt or two. That might be cool. So if y'all think that's a good idea, give me a thumbs up on Facebook or thumbs up on YouTube, and I'll talk to Zach and the BiggerPockets crew, see if we can get that done. And by the way, I just want to give a shout out to BiggerPockets. Like all of us benefit from using the website. Most of it's for free. And it's just been really cool to see behind the scenes all of the awesome people who are doing really good work to make it like work seamlessly. And in my case, it was not seamless when I got on this call. Had some tech issues, and my man Zach got me straightened out. So thank you to all the BiggerPockets crew. You guys are awesome, and thanks for helping me out. All right, Chris Edwards says, thank you so much. Love your website. Looking forward to listening to your book. Glad you narrated it yourself. I'll definitely check out that Capital One 360. Awesome, Chris. Very good. Thank you. Dominique Hart said, can you explain how to calculate the cash percentage part of the equation? Sorry if you already went over this. No, that's a really good question, actually. Thank you, Dominique, for asking that. And welcome to the chat. All right, I'm going to use really, you can make this complicated or you can just kind of keep it simple. But let's say I'm just going to assume, make a couple assumptions here. One, just to make my math simple, I'm going to assume that you just paid cash for this property. And that might not be the case. You might have put a down payment, and in that case it would be a little bit different, but it's the same general principle. But I'm just going to give you a simple example where you pay $100,000 for a property. And if you're in California, multiply that times 10 or whatever number you got to do. But there's a lot of parts of the country where you can still buy a property for $100,000. So we'll go with that nice round math. And so you had to invest capital. So let's just say you had your own money of $100,000 to buy this property. Now let's say that the rent on the property, and let's actually use the example that I had earlier where you had $1,200 in rent and you had $600 in expenses. So you made $600 per month, or $7,200 per year in net operating income. That's called your NOI, net operating income. That's deducting all of your expenses except for your mortgage payment and not including like taxes or depreciation and things like that. So $7,200. So that is after we've rented it out, that's the amount of money, because we have no mortgage, it would actually be in our bank account at the end of the year. So we've collected $7,200 in cash flow from this property, net income. So to figure out R, that was the original question, like how do you figure your cash return? You would just take this number, 7,200, because that's the amount of income your property produced, and you would divide it. So you do, in this case is income. So your income divided by your total investment, your cash investment. So your income divided by your cash, and in this case that's 7,200 divided by 100,000. So that's the first step. 7,200 is my income, net operating income. My cash is $100,000, and so y'all can do the math as well. I always encourage you, like, do it yourself. Like, what's 7,200 divided by $100,000? 7.2%. So that would actually be a really good rate of return on a good property. If you could buy a quality property in a good neighborhood and get a 7.2% cash return on, if you just paid cash for it, it's called a cap rate. There's another term for that if you're new to all this. That would actually be pretty good these days, because there are people who are buying properties these days right now for 4% cap rate. So they're making $4,000 on a $100,000 investment instead of $7,200. They're generally, for my own scenarios, like for me to get excited about a deal, if I'm not finding a 7 to 10% cap rate, like that's my, like I want to make on $100,000 invested, like if I just paid cash for it, I want to have $7,000 to $10,000 a year in income coming in. Now, why do I start with that math? Like that's my R in this case, because in most cases, right, we have mortgages on the property. Most of you are going to put a down payment and get a mortgage, right? And if you get a good mortgage, if you get a 4% mortgage or a 5% mortgage, 30-year loan, typically your cash return is going to be a little bit higher than your cap rate. You're going to have some positive leverage, a good return. So if you had a 7% there and then you also decided to get some leverage and put 20% down and get a 4% 30-year loan, if you get a good loan, that might go to 10% or 8%. It's going to be better than that. But I like to start with that number, because ultimately you're going to, in my scenario today, I was talking about paying those properties off. And so that's how I start with it. But you're going to need to think about your scenario, whether you made just a down payment or whether you paid cash for it 100%. You just need to figure out how much cash did you put in the deal. And so if you had a down payment, you would substitute, instead of $100,000, you would put your down payment. Let's say that was $20,000. And instead of $7,200 per year, let's say we had a return of $3,000 per year, and after paying all our mortgage expenses. So in that case, what is that? That's actually would be really bad, wouldn't it? $20,000 a year. So 10% would be $2,000. No, that would actually be pretty good. So you'd have maybe a 15% cash return. So now in this case, you'd have, instead of 7.2%, you'd have about a 15% cash return. So it's all, the math is flexible depending on what your actual scenario is. But that's the general way you figure out the R and figure out what kind of return, cash return, could my property produce. Awesome. All right. So good question, Dominique. I'm looking on Facebook still. Michael Malone says ×2 on the t-shirt. Just ordered your book. Excited to read. Thank you, Michael. Appreciate you getting the book. That's awesome. Thank you so much. Juan Carlos Flores says, thanks, great information. Awesome. Thank you for being here. Alan Sweeten got on late. What software do you use for 2 to 3 properties for tracking expenses? I recommend a software called Canva if you're doing this, like managing 2 or 3 properties. It's a free software. The only thing the way they make money is when you have a tenant who pays for a what do you call it, credit check or something like that. They make money on the credit check. Everything else, they have a ton of good features. And so if I had 2 or 3 properties, I would stick with Canva. I also might, if you're going to get a little bit more beefed up bookkeeping software, I like to use QuickBooks. I've used QuickBooks for 16 years and know it really well. And you can get QuickBooks for between, if it's on sale, a deal, $100 to $200 for the whole package. So I like QuickBooks a lot. And I actually might teach another training one of these days on QuickBooks and how to use that for rental properties. So if some of you are interested in that, give me a thumbs up and let me know in the comments so I can know that might be something some of you would be interested in. Joshua Darville says, how can I contact you? How can I contact you and follow you? I'm on coachcarson.com is my personal website. I'm also on BiggerPockets, and I write on the blog there, so I have articles coming out there as well, and I'm active. If you tag me in the forums, I'll see that. So see me on BiggerPockets. You can go to coachcarson.com as my personal website, and so those are the places you can find me. All right. Thanks. Juan says he's going to buy the book. I'm going to go for a couple more questions, and then we'll start wrapping it up. Dominique says, and if you got the house from a tax lien or a tax deed, the percentage would be higher, correct? Yeah, so what she means, if you were able to get it at a really low price, like if you bought the property with a tax deed, which is a whole nother conversation, is one way to find deals is to go like pay the property taxes on properties, and every once in a while you might get a really cheap deal where you buy a property for $5,000 and it rents for $600 or something. That's possible. It doesn't happen every day, but it's happened to me for sure. And so in that case, I think it's, yes, you would look at that and say, how can I, you would have a much higher return on investment. So it says thumbs up on the QuickBooks training. Awesome. Thank you. I'm going to wrap this up because my kids are getting off the bus in a few minutes. And I might have to run out of there. If I run off really fast, that's where I went. Actually, no. Let's have somebody else here. Let's see. So thanks for answering. What is the name of your book? Allie Edwards on BiggerPockets chat says, what's the name of the book? It's called Retire Early with Real Estate. And so it's a strategy guide on how to use real estate to retire early. And I share a lot of case studies on examples and show you like the step-by-step methods to whether you're just starting or whether you're farther along, how to use that to retire early. So I hope you'll pick up a copy. It's available on BiggerPockets right now. You go to the store, it'll be the first thing you see on the store. It also, later on, it'll be in all the normal channels. Like if you go to Barnes & Noble or if you go to Amazon, those places, it'll be there as well. But you get a lot of goodies if you buy it on BiggerPockets because I recorded some interviews. Like one of my mentors and favorite teachers was a guy named John Schaub who wrote Building Wealth One House at a Time. And so I interviewed him. I interviewed a few other people like Arian Shihai, who was on the call earlier, or on the chat earlier. And so I interviewed them and asked them, like, pick their brain about retiring early and how they did it and what's going on in their mind. And so if you get to buy any of the books through BiggerPockets, the audiobook, the digital book, I believe you get the bonuses in those cases. All right, so I got some more thumbs up for QuickBooks training from Michael Falkenberg. Thank you, Michael. Rick Bergen says definitely interested. Awesome, thanks for being here. Let's see, one more question and then I'm going, yeah, there's a link. So Zach put the link to the book in the Facebook chat if you guys are on there. So I'm going to do one more question and then I'm going to jump off, but this has been awesome. I'm glad the sound worked and I'll be back for more if you guys think it's helpful. So I've got a lot of different topics I can talk about from the book and I just love your questions and getting to find out what's going on in your life as well. So let me look on YouTube because I haven't checked in with you guys in a little while and see what your questions are. All right. So last question. So Fast Root Cloners says, we're going to keep and rent one of our 3 current flips as a rental and sell the other 2 and get right into multifamily. All right, cool. No, that's good. So just sharing that. That's a great way to do it. That's actually another way I did it. I would buy 3 properties, sell 2 of them just to pay the bills and to make some money, and then I would keep the 3rd one and use that as my rental property. I love that strategy. If you're already out flipping houses, just don't get into the trap of always flipping, and someday you're going to make, you have enough money to stop. Like, have a deliberate strategy to like have some flips, some keeps. And in my opinion, like the more you can keep and not have to pay the really high taxes on with flips and having a business, the better. Like we really started building wealth when we just flipped enough to make money and to pay our bills, and the rest of them we started keeping. Like buying and holding wealth and how much you have to like pay income down the road has been the wealth builder, the big wealth builder for us. I mean, you can flip houses and if you save all that money, great. But when you make a lot of money flipping houses, it tends to go through your fingers and goes to the next deal as opposed to actually saving it. So that's my recommendation. So last question, Fast Roots Cloners said, if you were married, it's good just only put one name on each property, then you can still get 10 loans. Okay, so he was just making a recommendation on if you can do that, if you have enough income as a couple, if one of you could buy 10 properties, the other could buy 10 properties, you might be able to get more bank loans. So that's a good tip. All right, so with that, guys, thank you so much. It's been about an hour and 20 minutes. Y'all have been awesome. Like, I love the BiggerPockets community. This is so much fun chatting with you. My name is Chad Carson. You can find me on BiggerPockets, and if you look on the BiggerPockets blog, I'm one of the authors there. You can find my book, Retire Early with Real Estate, there. And if you want to connect with me personally on my personal site, I'm at coachcarson.com. I have a weekly newsletter where I write about these kind of topics, early retirement, financial independence, and would love for you to connect with me there as well. And so I will be back for another live stream soon, and I really appreciate your time and your attention, and I'll check in with you later. Y'all have a great day. Thanks.